Thank you. First and foremost, I would like to welcome all the stakeholders to today's session. The theme of today's webinar is examining the future of financial inclusion, key opportunities and challenges, setting the stage for inclusive integrity. And as we move into the session, we have three very powerful panelists with us today. And just to talk to the stage, before we allow the panelists to come in, is one, we have a dual mandate. One is looking at inclusion and integrity. In today's financial landscape, there's a growing recognition that advancing financial inclusion and safeguarding financial integrity are not competing goals, but complementary ones. The challenge is making them work together in practice. Two, when we look at the evolving global standards and local realities, we see the standards on AML, CFT, and CPF are becoming more stringent. And when we look at the aspects of their local implementation, especially in developing and undeserved markets, we find that it can unintentionally limit access to financial services, particularly for low-income and informal sector participants. Thirdly, when we look at the risk-based approach, is it a tool or a barrier? The risk-based approach is central to the Financial Action Task Force guidance and national regulations, but its effectiveness depends on how well it's implemented. When misapplied or overly cautious, it can actually exclude the very populations we aim to bring into our financial systems. Another component that we have to look at is innovation, data, and proportionate regulations. With the rise of digital financial services, mobile money, and alternative data, there's actually a huge opportunity for us to rethink how risk is assessed and managed, thus making compliance smarter and not harder. The aim now is to ensure that we make it inclusive by design. Lastly, we're looking at the role of practitioners and policymakers. Striking the right balance requires collaboration across regulators, financial institutions, and technology providers. To help ground this discussion, I would like to invite our first panelist, Robin Newman, who brings hands-on experience in regulatory affairs, banking governance, and national AML-CFT frameworks. Who is Robin Newman? Robin Newman is head of policy, analysis, and guidance at the Alliance for Financial Inclusion, AFI, a global network driving inclusive finance across 85 plus emerging and developing economies. He leads work on cutting-edge financial inclusion trends from fintech, innovation, and regulatory reform to the role of finance in achieving the Sustainable Development Goals. Robin also represents AFI in high-level dialogues, including with the G20 and global standard setters. Prior to AFI, he served at the UK Treasury for 7 years. He holds a master's in philosophy in international relations and a BA in modern history from the University of Oxford. I take this opportunity to hand over to Robin to take us through his topic, which is advancing financial inclusion on AML, CFT, CPF. Thank you, Robin.
Thank you very much, Hilda, for the kind introduction, and thank you to ACAMS for the invitation to this webinar. I'm really thrilled to be joining your discussion here today. So as Hilda said, in my brief talk today, I'll be addressing the topic of aligning financial inclusion with the objectives of financial integrity that I think your community is traditionally a bit more focused on. And I'll talk a little bit about recent initiatives in the Financial Action Task Force, the FATF, that have been aimed at strengthening this alignment, as well as a few examples around how to achieve this in practice at the country level. And I do hope you find it useful. So going to the first slide, I'll give you a little context on the vantage point I'm speaking from. So the Alliance for Financial Inclusion, as Hilda mentioned, we comprise of central banks and financial regulatory bodies from more than 80 countries in the Global South. AFI is 17 years old now, so we've been around a little while. And those member institutions all share a belief that universal access to the financial system is really a basic human right. But more than that, it's also a key driver of many other economic and social goals. So our members see it both as the right thing to do, but also as a multiplier for the Sustainable Development Goals and for inclusive growth strategies as well. And whilst our primary mandate is, of course, financial inclusion, we've also long prioritized engagement with those global standard setting bodies responsible for financial stability, like the Basel Committee and the Financial Stability Board, and those responsible for financial integrity standards, the FATF being chief amongst them. And that's really in order to ensure that these global standards are developed with financial inclusion considerations in mind, and that as far as possible, we can mitigate unintended consequences that might arise for financial inclusion. So we participate actively in FATF and also several of its regional bodies, including ASAMALAG and GIABA on the African continent. Going on to the next slide, I'll come on to some definitions. So firstly, what do we really mean by this term financial inclusion? And I think sometimes there is a bit of a misunderstanding here that financial inclusion is just about getting the unbanked bank accounts or maybe mobile wallets. And that indeed can be a useful starting point, but it's very far from the end goal. Because financial inclusion should really be about equipping everyone with the tools that they need to live financially healthy lives. It's about fundamentally helping people from all walks of life to help themselves, to work towards their own life goals. And for that reason, we typically talk about the three key dimensions of financial inclusion. So access is just one, and then usage and quality are the others. To illustrate that, if you have an account that you receive a government benefit of some kind, but you just use that account to withdraw and continue operating in cash, then you have access, but not really effective usage or quality. And if you have a mobile money account that you're actually using regularly to transact, to send money, but maybe that mobile money provider is the only one in your country, so the fees are pretty high, and maybe there's no mechanism for consumer complaints if something goes wrong. So then you have access and usage, but you're lacking the quality dimension. So to achieve effective financial inclusion, all three of those elements really need to be in place. Then moving on to the term financial integrity. This, of course, can mean different things in different contexts, but in a FATF setting, it's usually understood as keeping the financial system free from illicit financial flows, and especially through those three key areas of money laundering, terrorist financing, and proliferation financing, which are covered by the FATF standards. Then on the right-hand side, we introduce the term inclusive financial integrity. And here we're just really talking about achieving a sound alignment between the first two objectives. We do absolutely believe in AFI that those goals are complementary, but also that achieving that complementarity in practice requires a lot of intentional effort. It won't just happen automatically. It requires consistent and high quality stakeholder dialogue to really break down those policy silos that can often exist between the two worlds. Going on to the next slide, we'll take a look at what is the current state of practice when it actually comes to aligning financial inclusion and financial integrity in reality. So it's important to say that FATF, as the standard setter, to its great credit, it has long recognized that financial exclusion does pose a risk to its core goals. And that really makes sense, since if we have a high volume of economic activity taking place in the informal, unregulated sector, it allows transactions to take place that are unmonitored, and it can create core risks to the FATF's principal objectives. And as Hilda mentioned in her introduction, FATF therefore did provide a mechanism whereby financial inclusion considerations can be taken into account in implementation of the standards. And this, of course, is the risk-based approach, or RBA for shorthand. And that's officially been part of the standards and guidance of FATF since 2012. And the RBA, of course, requires enhanced due diligence when assessed risks are higher, but it also allows simplified measures to be put in place when assessed risks are lower, as they quite often can be when we're looking at financial inclusion products such as no-frills bank accounts or maybe mobile wallets that have relatively low balance and transaction limits. But in practice, at the country level, unfortunately, these flexibilities have not been used often enough. And in fact, the FATF's own study a couple of years ago on the unintended consequences of its standards found that simplified measures for lower risk are actually being used less in developing countries than they are in advanced economies. So that means that the countries that have the highest levels of financial exclusion are actually not correctly deploying these provisions to achieve proportionality in practice. And as a result, as you'll see from the Global Findex that the World Bank publishes, including the last edition very recently, in a significant number of developing countries, ID and documentation barriers are still keeping too many people outside of the formal financial system. And of course, they have disproportionate impact on groups such as women, youth, people with disabilities, migrants and refugees, all of whom are often impacted most heavily by KYC and other AML norms, and they may lack the standard identity documentation requirements that financial institutions often insist on. Going on to the next slide, I'll ask the question, why is this the case? Why didn't the risk-based approach that FATF introduced back in 2012 just fix this problem when it was introduced? And I think a helpful way to look at this challenge can be through the framing of permissions, incentives, and capacity. So the risk-based approach did a fair job, I think, on permissions. It does provide a mechanism where simplified measures can be applied in cases of lower risk, including to advance financial inclusion. But it's important to note this was only ever optional. So it's optional, first of all, for countries to allow simplified measures. And then it's also optional, again, for regulated financial institutions to implement them. So looking back, we can see that permissions without adequate attention also to incentives and capacity has not been enough. And in many countries, that has unfortunately led to unintended consequences for financial inclusion. So the changes that FATF has introduced to its standards and guidance this year, following the FATF presidency, making financial inclusion one of its top priorities, they have focused really on strengthening the incentives with regards to identifying lower risks and putting in place proportionate measures. And time will tell how effective those changes have been. But we should note, even then, we're still left with the challenge of capacity. And this is one that's going to need a multi-stakeholder approach going forwards. Because, of course, for the risk-based approach to function effectively, we really need every actor in this AML-CFT ecosystem to understand and be well-equipped to carry out their function, from the policymakers through to the FIUs, to the supervisors, to the private sector and regulated entities. And at the heart of all that, of course, is capacity to conduct evidence-based risk assessment, which stands at the core underpinning of the whole system. So I think we're going to see a lot of focus on capacity building through these different sectors over the next couple of years. Going on to the next slide now, I just detail here the specific changes that FATF has made to Recommendation 1 and its associated interpretive notes earlier this year following a public consultation. So firstly, there was a terminology change to Recommendation 1 to use the term proportionate rather than commensurate. So AML-CFT measures put in place must now be proportionate to the level of risk. Secondly, there's also now an explicit requirement for countries to allow and encourage simplified measures in lower risk scenarios. So whereas before, as I mentioned, the simplified measures were merely optional, there is now an expectation that jurisdictions will actively encourage their appropriate application amongst their regulated entities. Thirdly, supervisors are now expected to review and take account of risk mitigation measures undertaken by financial institutions and look whether they are appropriate to the institution's risk assessment and risk appetite. So there are powers now for supervisors to challenge where they believe there's overcompliance that could be having a financial exclusion effect. Fourthly, there's now an acceptance by FATF that non-face-to-face relationships and transactions shouldn't be regarded any longer automatically as high risk, provided there's appropriate risk mitigation measures in place. And that's really just reflecting the reality that most financial services today are digital services, and that there are very robust technologies that can now be used to remotely identify and verify the identity of clients. And finally, there was a change regarding the exemption for particular types of institution, that previously this could only be implemented in cases of proven low risk. Now the language is assessed low risk to make it clear national and sectoral risk assessments can be used to allow such exemptions. On the next slide, you can see that FATF followed up these changes at the February plenary by publishing an updated guidance document on AML-CFT measures and financial inclusion that also went out for consultation, and the final guidance was adopted at the recent June plenary in Strasbourg. I do recommend everyone to have a look at that document. It's 150 pages. It's got quite a lot of rich detail. And I think it is a helpful step forward in a number of respects. To start with, it broadens FATF's definition of financial inclusion beyond access to now also cover those other dimensions I mentioned of usage and quality. And the guidance also provides quite a rich variety of good practice case studies, with a particular focus on the application of simplified measures in lower risk scenarios. So that can be helpful to see how other jurisdictions have handled implementation of the risk-based approach. There's still, of course, some limitations or some gaps. This guidance only covers AML and CFT. It doesn't cover proliferation financing, but we do think there are some aspects of the proliferation financing requirements that could also impact financial inclusion if proportionality is not there. We also think there's areas such as how terrorist financing risk can be assessed as lower in practice, which is more complex than with money laundering risk, that may need a bit of attention going forwards, as well as additional guidance in cases of where inclusion is needed, but the populations concerned may not automatically be considered lower risk. So for example, refugee populations, you still want to include them, but you can't just necessarily say that they're all low risk. And that's an area we have some additional tools and guidance on in AFI. Go to the next slide now, please. So beyond the FATF guidance, how do we actually advance this vision of inclusive financial integrity in practice? Well, this is a core area for AFI. So we do have quite a rich set of resources, case studies, guidance related to particular demographic groups such as women, people with disabilities, refugees. I'm happy to share some of those resources with you. But our flagship product in this area is the Inclusive Financial Integrity Toolkit that was developed back in 2020. We are working on a version 2 now that will incorporate the new FATF changes to standards, and that will come out in 2026. But I think this is still a good resource coupled with the FATF guidance to look at practical steps that can be taken to achieve this alignment in practice. And importantly, this document was consulted on with the FATF, with FSRBs. So it's designed to be consistent and complementary to implementation of the FATF recommendations. On the next slide, you can see that the toolkit's broken down into different chapters that cover respectively strategy and policy, regulation, supervision, also processes such as risk assessment and mutual evaluation. So it's really intended to be a very practical product that the policymaker or other actors as well can have to hand as they're working through some of these challenges on a day-to-day basis. On the next slide, you can see that the toolkit has a number of key recommendations. Of course, everything starts with defining a shared vision of success for inclusive financial integrity at the national level and communicating that well to stakeholders. And robust and inclusive risk assessment is absolutely key underpinning to ensure that there's shared understanding of risk by all stakeholders. And the toolkit also has some recommendations around leveraging technologies such as digital ID and SupTech, and also some best practices in the area of risk-based supervision. Now coming on to, I think there's a few country examples also in the toolkit. I think you'd also find those useful, and some of those have been repeated now in the FATF guidance document recently published. And next slide, please. Yeah, and the next one, actually. This is my last slide. So just to flag some areas that we think still warrant attention going forwards, despite the good progress that's undoubtedly occurred under the FATF president's initiative over the last year or so. So this includes the challenge of wholesale de-risking that's still particularly impacting certain jurisdictions and certain perceived high-risk sectors as well. And I know that's a particular problem here in Africa. Also, we think further work would be warranted to ensure the risks of financial exclusion are more deeply analyzed and embedded in the mutual evaluation process as well. We think FATF could helpfully tidy up its current guidance on risk and risk assessment. There's separate documents right now on money laundering risk, on terrorist financing risk, and proliferation financing risk, all with slight inconsistencies, different terminologies. So I think a synthesized view of risk from FATF would be very helpful and timely. And then the fourth bullet, this is feeding back to the point on capacity that I mentioned. Even now, the standards and guidance has been adopted by FATF members. It will be very critical that this is followed through downstream, especially in regard of trainings for supervisors, assessors, and other AML, CFT, and CPF actors. So these are just some thoughts on what the future of inclusive financial integrity might look like that I'll leave you with at the end of my presentation today. So I'll conclude there. I think I'm out of time, but very happy to take any questions later on if you have any. Thank you so much.
Thank you, Robin, for an excellent presentation. And as I've listened to you, a key takeaway is the Financial Action Task Force clarification that countries and financial institutions should apply the risk-based approach that supports financial inclusion and that does not inadvertently exclude legitimate customers from the financial system. In terms of what this means, I liked what you have talked to, especially with respect to proportional controls, and more especially that low-risk customers and transactions should not be subjected to unnecessarily strict AML and CFT measures. There's also the aspect of avoiding de-risking. And here we can see the requirement that we have to undertake proper risk assessments so that we do not unnecessarily prejudice some legitimate customers as we try and get them into the financial system. Another key area I think that this is bringing and which dovetails very well into the next presentation is the aspect of encouraging innovation. And some of this would be the use of the digital identity systems as well as simplified due diligence for lower risk scenarios so as to promote the financial access. This would bring us to our next panelist, Henry Nyakundi. And here we're going to talk to the future of financial inclusion, and we're looking at perspectives, opportunities, risks, and the regulatory advancements. As we dovetail into this, we will also look at some of the practical aspects that have been brought from Robin's discussion, which is looking at the role of the regulators, who must ensure that the AML CFT frameworks support access to financial services, especially for the underdeserved, that financial institutions need to relook at the customer onboarding and KYC processes so as to balance risk and inclusion, and the opportunities that are actually being presented to the fintechs and digital providers who can now leverage the risk-based frameworks to innovate access while staying compliant. More important is how we can deepen the usage, the affordability, and the quality of financial services that are being offered to our customers. And as Henry comes on board, we will see that we will be looking at the digital ecosystem, and this spans the fintechs, mobile lending, the digital wallets, and e-commerce, which has opened up new channels for reaching the underdeserved groups, especially women, youth, and the informal workers who Robin has also talked to earlier in the presentation. Of course, as we're looking to this, we now know that there are emerging risks as we move or expand into this space. And one of the most critical things is how we stay ahead of these risks. And those are some of the things that will come out even as Kennedy is talking. We have to look at the aspects of regulatory evolution and coordination, and we are now looking at more regulatory responsiveness. What we appreciate is that innovation can outpace policy, and thus there is a need for more adaptive and risk-based regulation, which will not only protect consumers, but should also allow for innovation. A key component that also came out even as we were listening to Robin is the aspect of cross-border collaboration. And we can see that the future of financial inclusion requires more than just banks or fintechs. It actually demands a collaborative leadership across the public and the private sectors, civil society, and regulators to ensure that inclusion is both meaningful and sustainable. I will now present Hesbon Nyagaka Nyakundi, who is a seasoned communication and public affairs professional with a focus on advancing public awareness, stakeholder engagement, and inclusive policy advocacy within the financial services sector. At the Kenya Bankers Association, he plays a pivotal role in shaping the industry's strategic communication agenda, aligning sector narratives with national development goals and global sustainable commitments. With over a decade of experience at the intersection of finance, policy, and public interest, Hesbon has led impactful national financial literacy campaigns, championed accessibility initiatives for persons with disabilities, and driven sector-wide branding efforts that promote trust, inclusion, and equity. His work leverages strategic communication as a tool for bridging information gaps, fostering citizen engagement, and enhancing financial capability, particularly among the underserved communities. He is deeply committed to enabling equitable access to financial services through knowledge, access, and innovation that responds to real-world needs. I take this opportunity to welcome Henry Nyakundi to take us through the future of financial inclusion. Henry, welcome.
Thank you very much, Hilda, for those kind words and of introduction. And I think I would like to start by thanking ACAMS East Africa chapter for inviting us to participate in this insightful webinar. And really like to build up on what Robin has talked to us about. And really, ours is really more on the as KBA, as the Kenya Bankers Association, which I'll talk about later, we are at the interface of between the market and the regulatory environment. So I'll be highlighting those aspects in the course of my talk. But before I begin, allow me to teach you some sign language on how we sign in Kenya. In Kenya, we have a program for persons with disabilities in the banking industry. So we are training bank staff and also customers on how to sign in Kenyan Sign Language to address the challenges of accessing financial services for persons with disabilities. So if you want to say hello in Kenyan Sign Language, you just say hello. Next slide, please. So as I spoke at the beginning, I work for the Kenya Bankers Association, and the Kenya Bankers Association is actually the umbrella body for all commercial banks in Kenya. And our work really focuses on influencing laws, regulations, and policies within the financial sector with the aim of really improving access to affordable credit for both individuals and households in the economy. We have 46 member banks, which represent 7.7 trillion in assets, which is approximately 59.2 billion. So that's about the Kenya Bankers Association. Now I'll move on to the next slide on the initiatives that we have conducted as an industry to really strengthen financial inclusion. We have a financial literacy program called the Chora Plan or Plan Your Money Initiative, which really targets to provide financial education to the youth to influence financial decision making. We also have another program called Inuka or Rise in English, which really seeks to de-risk MSMEs through capacity building to facilitate access to credit. Then, of course, I've alluded to another program that we have on the digital and accessibility for persons with disabilities, where we seek to really support banks to improve their physical infrastructure so that they're accessible to persons with disabilities, and also other interventions like enhancing communication between the banks and persons with disabilities. So those are the three main areas of focus, of course. And also we have one more program which seeks to also, educate the public about fraud. Because as an industry, we've realized that actually fraud is one of the threats, as I will talk later in the course of this presentation, that threaten to reverse the gains that have been made in terms of financial inclusion. So I'll move on to the next slide. And here I just wanted to paint a picture on what the scale of the challenge looks like, and also the opportunities that are available. I know Robin spoke about that actually financial inclusion goes beyond just being banked. It has aspects to do with access, usage, and the quality aspects. And here what we see that there are a lot of people globally who are unbanked, according to the World Bank, actually 1.4 billion. And also here we are seeing, gaps in terms of gender and disability gaps. And maybe to give you a highlight on the industry perspective on this, the KBA is supporting the Kenyan banking industry to do gender disaggregated data to understand the needs of women-led businesses so they can be able to support them better. And also we see that only 30% of adults in low-income countries have saved money formally, which really speaks to the gap that exists there. And also we see an opportunity in terms of how mobile money is presenting new opportunities, with new accounts exceeding 1.35 billion globally, according to recent industry estimates. I'm moving on to the next slide. I would like to, so this is what the picture looks for us as an industry in terms of the future of financial inclusion. Our focus really now is in terms building into the aspects of access, usage, and quality. The Kenyan market is really keen on providing affordable and accessible credit. So there are two elements there: affordability and also accessibility. We see this as a frontier of economic empowerment particularly for small enterprises and youth enterprises, women, and also persons with disabilities. We have seen that in Kenya, many SMEs actually account for 98% of all businesses, and also they contribute a large proportion to the Kenyan economy at about 40% of the Kenyan GDP. The other frontier we see for the future of financial inclusion is the aspect of financial product awareness. Here we have highlighted the fact that the approach of one size fits all is no longer working. So there is need to do a lot more in terms of creating awareness about products to the public, and also to highlight the fact that there are solutions within the financial services system that can empower the individuals and businesses in the economy. The other aspect we see here is about customization of services, also building on a product awareness. And segments like SMEs, women, and also persons with disabilities actually require customized services or customized solutions to address their specific needs. And here, what we recommend is to have the customers in mind in the product development journey, so that they're able to put in their feedback, so that the solutions or the products that come out of the market eventually are aligned or respond to the needs of the market. Moving on to the next slide, please. So here I wanted to paint a picture on the opportunities that exist within the segments that we are focusing on, that is women, persons with disabilities, MSMEs, and the youth. And there's actually a need for us to close the gender finance gaps, which could unlock up to 300 billion annually, according to estimates. And I think I mentioned earlier that the banking industry, through the guidance of KBA, is currently working on a partnership with FSD Kenya to obtain gender data that will enable banks to support women-led businesses better. Then moving on to the other aspect of the importance of ensuring persons with disabilities have access to financial services. There is an urgent need for the financial service providers to address the needs of persons with disabilities through services that respond to their needs, and also products. The other aspect I wanted to highlight is we have highlighted the huge contribution of SMEs to the economy. And so there is a prevailing or persistent trend of underfinancing. And here we see that the key driver here is the risk perception, which remains a key barrier for many of these enterprises. And so the solution here really we talk about is to ensure that you support the SMEs in their formalization journey, because we see that one of the leading drivers of this high risk perception for MSMEs is actually the aspect of being informal, which can be addressed through initiatives that are designed to enable them to formalize their enterprises. Then we also have another opportunity in terms of the youth population, which is actually a huge percentage of the population in the emerging economies. And these are actually digital natives. So there are prevailing digital credit restrictions that affect this segment. And here, one of the key ones you have identified in the Kenyan market is poor credit history, which can be fixed through financial literacy programs to let them know the importance of keeping a good credit history, the importance of paying back your loans, so that we can be able to support them to access credit. Next slide, please. So we see opportunities also as a digital innovation as a new frontier for MSMEs in terms of enabling their financial inclusion, their mobile wallets providing lower transaction costs by up to 80% is actually an opportunity for MSMEs. Then building into that, we see the growing mobile money usage in the economy, which could actually support SMEs in a big way. And then there's also a growing trend of adults accessing financial services. So the opportunity here is that the usage of technology to improve credit access for MSMEs is a great opportunity, especially that is not based on traditional collateral. Next slide, please. So as I highlighted earlier, one of the risks we see for financial inclusion is cyber and payment fraud. Which can actually be addressed through education or programs that educate the public about trends on in fraud and how to address them. Then there's also the aspect of predatory lending, which can be addressed through policy and regulatory systems. And then also the poor digital divide, which exclude many, especially from accessing digital banking services. And then, of course, we have the emerging threats of data privacy gaps. Next slide, please. So now I want to look at also how we can design safe, inclusive systems. And so one of the ways is to ensure that products are designed with the consumers in mind. I think I've alluded to that in the previous slides. And then there's also a big opportunity for us in terms of developing digital literacy, financial literacy programs to scale accessibility and also usage of financial services. And also, we have seen from the industry customer satisfaction surveys you've conducted the importance of having inclusive systems of addressing complaints and support, because banking in most cases is actually based on relationships. And then, of course, the aspect of data governance frameworks that are aligned, to the best practices globally. Next slide, please. So as I conclude, in terms of the recommendations that we have is to scale inclusive AI tools in the markets for credit analysis, risk analysis, and also fraud detection. Then also promote alternative data for scoring in terms of credit, because we realize some elements are missing in the credit scoring mechanisms that also ignore the people who use other platforms for transactions or banking. And then there's also need for us to build gender and disability sensitive products. This is actually more in terms of aligning to the needs of the various demographics in the market. Then, as I conclude, there's a need to enhance regulatory sandboxes for fintech experimentation. It's like to build the interface between banks and fintechs to really entrench and deepen financial inclusion, and also empower frontline staff with inclusion and risk training. So in the Kenyan market, we are working on training the front-facing bank staff on Kenyan Sign Language to communicate with the deaf community, and also the importance of collaboration in promoting inclusive finance. So Hilda, I think I'll stop there. I think I've overrun my time. If there are any questions, I'll be happy to respond. Thank you.
Thank you, Henry. Yes, I can see we're running a bit tight on time. So what we will do, even as we move into David's session, because David was actually talking as to how risk-based approaches are shaping both both positively and negatively the landscape of financial inclusion, and highlighting the real-world practices, the lessons learned, and opportunities for balance between regulation and access. I also believe it will talk quite well to one of the questions we have seen on the chat, which, David, I believe you can take as part of your discussion, which is what role can regulatory bodies play in incentivizing banks to close gender finance gaps? So, David, I hope you have noted that. And as we're looking at it and just building on from what has come from Henry, I think what's come out clearly is that despite the notable progress in access to financial services across the emerging markets, millions still remain undeserved or excluded, particularly women, youth, and some of the other population that could be disadvantaged, including the micro enterprises. We have also seen that as financial systems are evolving, the regulatory environment is evolving, but not as quickly. And as a result, we're seeing there are some unintended barriers that are being created. Now, the other aspect is that where we're using the risk-based approaches, of course, to mitigate the actual compliance risk, they can make our systems more efficient. However, because of the regulatory expectations, we tend to find that they're being, and especially when we're looking at the components of documentation, we find that it can disproportionately affect those with those limited documentation or who do not have access to the formal identity systems. So we now have a balance in terms of finding the balance between ensuring financial inclusion, innovation, and how to ensure we do not exclude this population that perhaps does not have or cannot fully comply with some of the regulatory requirements but we need to bring them into the financial system. To that effect, we are joined by David Nyamato. David Nyamato is a seasoned banking professional with over 20 years of experience across the financial services landscape, including commercial and investment banking, leasing, bancassurance, and fintechs. He is recognized in governance, compliance, and risk management, and has spent over 15 years at the forefront of developing and executing strategies that strengthen institutional resilience and regulatory alignment. Currently, David serves as head of governance, regulatory affairs, and stakeholder relations at NCBA Bank, and also chairs the compliance committee of the Kenya Bankers Association, KBA. Beyond institutional roles, David has been actively involved in national policy development, most notably through service on Kenya's National Task Force on Anti-Money Laundering and Counter-Financing of Terrorism, AML-CFT, where David contributed to the country's first national risk assessment report. David brings a strategic lens to regulation and compliance with a commitment to fostering collaboration between financial institutions, regulators, and stakeholders to build a more secure and forward-looking financial ecosystem. David, over to you to take us through the session as to how risk-based approaches are shaping both positively and negatively the landscape of financial inclusion. Thank you. And I hope you did note the question, which touches on your area, which was more specifically, what role can regulatory bodies play in incentivizing banks to close some of the financial inclusion gaps, such as gender finance gaps? Over to you, David, and thank you.
Thank you very much, Hilda. And I would also similarly wish to express thanks to ACAMS East Africa for extending the invitation to participate in this webinar. Happy to be involved and also to participate, discuss these matters with the participants online. And to the participant who sent the question, thank you very much. I certainly did note it, and I will do my best to then address it during this conversation. When you look at financial inclusion, and interestingly, before my life in compliance, I actually started in business development. So it's a very interesting area. And we could talk about this all day because there are very many aspects to financial inclusion. But I think the gist of it, we've already received, from Robin and Hasbon, their excellent presentations, some highlight or insights on what financial inclusion is all about, talking about financial integrity, And therefore, I'll try and not repeat what has already been said, other than just to stress that a well-regulated system, financial system, is also resilient. It's a resilient one and is able to then help the populace to at least achieve economic freedom, among other things. If I were to ask the participants online today, what does financial inclusion mean for you? I'm sure I'll receive varied responses in terms of what it means or what it should look like. But I think, to summarize what it would mean for most of us, or at least I believe all of us, it has to be a system that brings out some form of dignity and autonomy for those who use it. Because again, we are targeting the vulnerable populace most of the time. It brings about freedom of choice, as opposed to necessarily control or cooptation. And a sense of belonging, shared responsibility, just as we do within communities, but more importantly, sustainability. So at the end of the day, it's about access to empowerment. And when we talk about access to empowerment, I know there have been many solutions that have been touted as being excellent for financial inclusion. However, sometimes we just need to scratch the surface, and we know that they may not yet have reached the final or the ultimate status of being a financially inclusive product. Just to give an example, is if we look at the costs associated with accessing those systems. In many cases, it's very expensive. And that then does affect the ability to really bring about true financial inclusion. Be that as it may, I think now we just need to also understand the flip side of the coin, or rather extend it more or less on the same side, and then we shall look at the flip side. What then happens if there is exclusion? I think it's important for us to understand this so that then it adds value to our discussion today. One certainly is it will bring about the thriving or proliferation rather of informal financial channels. I think one of the more popular ones that are well known globally is the Hawala networks. That is an informal financial channel. The risks that come about because of it is limited access to information or transaction information that would enable then monitoring and reporting in terms of our obligations under AML CFT. It exposes the users to a higher vulnerability to fraud and theft of their funds. And this not specifically to Hawala, but to many informal financial channels, because there's no protection that is provided to the users of those mechanisms, of those channels. And certainly because it is opaque in terms of not being able to see the records of financial transactions, it has the potential to be abused in terms of illicit financing. Then there's prevalence of cash-based transactions, within these informal channels. So the unbanked populace, more often than not, will rely on cash-based types of transactions to settle their obligations or to perform trade transactions, for instance. And this also includes cross-border trade and remittances of cash. If I look at, for instance, one of the popular documentaries that was done by Al Jazeera on the gold mafia, it does present, a very strong case of how this occurs. And the risk with it, of course, is that it does provide anonymity and addressability. There's a smuggling aspect of it, and that reduced visibility then exposes the financial system to even other risks such as tax evasion. And then we have issues such as proxy financing. And when you're talking about proxy financing, so we have in Kenya, and bear with me as I'll use a lot of examples from Kenya, it's the most expedient for me. We have instances where people share SIM cards, so on mobile telephony and digital wallets. And therefore, you could have an instance where one party is actually a front for somebody else, and all may look well, but if you are to find out who the beneficial owner really of that transaction, it will be someone perhaps who is sanctioned. And that again exposes the financial system. So misuse of identity or even identity theft could possibly occur in such cases. We have serious challenges in tracing beneficial ownership. And then there's the facilitation of layering, which is a key problem, a significant issue when it comes to money laundering schemes. Sorry. And then we are talking about also issues to do with cross-border informal remittance systems. So we have, I think, in the past cases noted where what started as an innocent mechanism, such as back, let's say 2-3 decades ago, would have deliveries done, for instance, by bus drivers, long-distance bus drivers who take funds on behalf of people from the city back to the rural homes, or even other items of value. But now those have been misused or abused by actors who are participating in illicit activities to then use those mechanisms. And this extends to cross-border remittances and payment systems, especially when we are touching on conflict zones, such as Somalia. We have some issues also in the neighboring DRC and the likes. So what does that mean for us? I mean, when people are financially excluded, what it then means is that they are pushed to look for alternatives. And these alternatives are more often than not very high risk. They expose them to, fraud, illicit trade, illicit finance, potential for terrorism financing as well. And certainly then that would undermine the financial system in terms of its stability and transparency and the trust that would come with it. The positives, do they exist when we are looking at these alternative financial systems? I would argue that yes, positives do exist, because if there was no gap, then the alternative channels would not exist. And therefore, what this perhaps means for these for the participants within the alternative financial channels is accessibility. One, there's a low barrier to entry. So it's very easy for them to be able to participate within these informal channels, to be able to perform their transactions. Again, if I pick on the Havana system, so we have geographic reach, and this geographic reach can really extend way beyond the borders, our local or common borders. And we have transnational payments that are happening through those informal financial channels. They embed trust. And it's because people use them because it's been tried and tested, and they see that it works. There's some form of peer accountability. There are shared social norms, and this also brings in, the cultural appropriateness in terms of how those mechanisms work for various people. To give you an example again from Kenya, we have this mechanism known as Bangla Pesa, which started within the slums in the coastal region, Mombasa. So it's a community-based alternative mechanism for settling payments using a voucher system that works parallel, of course, to the national currency system. It was strongly opposed by the national government, but eventually I think the community prevailed and was able to demonstrate that it was not replacing the national currency or introducing a new currency, but really providing a mechanism that was able to support the community to be able to perform their transactions and meet their needs without necessarily having to have immediate cash available to settle those transactions. And then there are very quick turnaround times in terms of settling transactions. They are resilient. Those systems are quite resilient. So if we're talking about, for instance, those issues we are looking at in the conflict zones, they provide for continuity of service. So people are able to then continue surviving in terms of making their payments, making their settlements, supporting their relatives, even within, refugee camps, for instance, for those who have been displaced. And they can serve in many cases as a mechanism for, as a stepping stone towards getting into the formal financial system. So today we see a lot of innovations in terms of the digital solutions that are being developed, especially here in Kenya, quite a prevalence of them. And if I just pick on a couple of them, we have one is known as CHUMS, which helps. It was aimed at really helping the younger population to really develop a savings mechanism and to learn how to save and invest. However, it turned out to also be a positive solution for adults to be able to then perform, their savings and investment or achieve their savings and investment goals. And then we have another one called Chango, and Chango is mainly for crowdfunding, but has also become popular for these chama, what we call chamas, which are family or community-based groupings that come together to pool their funds to meet a financial objective. These mechanisms, clearly what they do is that they encourage savings, investments, planning. They enable people to then, those who are financially excluded, including also those who are financially included, to perform transactions in a very convenient way, and provides them that flexibility to choose an option that works for them best. When we look at risk, now that we're talking about AML, CFT risk mostly, many times we default to the negatives, and rarely do we think about the positive angles of it. I think the key thing then for us practitioners and policymakers, and we have to think about the aspect that informality does not equate necessarily with criminality. Yeah, so we have mechanisms that do fill systemic gaps. Are they exposed at a higher scale to illicit finance and illicit activity? Potentially, yes, compared to the formal financial system. But they do, I think the good outweighs the negatives. We should look at some of the strategic approaches, I think, as we discuss going forward. So we look at good, I think it was mentioned that I'll also touch a little bit on the good and negative practices when it comes to the risk-based approach. Thinking about good practices, we have now, the concept of proportional know your customer due diligence. Yeah, so adopting, tiered KYC approaches, a true risk-based approach to doing our due diligence, and simplifying it, especially for those who really do not have a high risk exposure to the financial system, would be really helpful, especially for low-income users. It reduces the cost of compliance, it reduces the cost of onboarding, and therefore encourages and enhances financial inclusion. And this is one area, for instance, where financial institutions globally can really be incentivized by regulators in terms of coming up with national frameworks that encourage proportionality of KYC due diligence. The other one is, I would say, is also the regulatory sandboxes. So we have, for instance, the Capital Markets Authority in Kenya, which was among the first regulators that set up the regulatory sandbox to encourage innovation and development of innovative solutions together with the regulator. So we have the innovators coming together with the regulators, thinking through it, looking at the risks, and then developing a solution that would really help to encourage or to grow financial inclusion. I think the third aspect around it would be around collaboration and especially public-private dialogue. So there's a lot of talk and a push for engagement between regulators, financial institutions, and also civil society to participate more in dialogue, understand one another, understand the risks, so that we can inform realistic risk assessments, the national risk assessments. Coming off the first one that we had a few years ago, and with some enhancements that have been done more recently, one of the positives that we experienced was that collaboration then enabled improvements and enhancements as we move along in terms of developing the frameworks, the regulatory frameworks that we need to put in place. From a practitioner perspective, now we look at some of the negatives, the bad practices or barriers, to inclusion. One is really a very strict interpretation or application of the due diligence standards. So when we push too much on over collection of documents, and this is mainly driven, in my view, by a low level, or let me not say a low level, but an inadequate level of sensitization on what risk-based assessment truly means. Yeah, the risk-based approach has to really consider different aspects. You look at the different sectors, the different categories of customers, their income levels, geographic standpoints, and so on and so forth. And bringing all this together is not easy. So it's usually easier to default to, I look at one category of customer, I apply the same standard of due diligence on them, and I'm happy. However, that does lock out quite a number of people, especially where they do not have the necessary documents that they may require. And it may be overkill in terms of trying to ask them for that so that they can, be onboarded. It may not be feasible to achieve that, especially for the vulnerable groups. And then lack of differentiation in terms of applying the KYC or due diligence rules. So blanket applications, I think in the past we've had significant concerns around how regulations are structured, because many times it's meant to be risk-based, but there are some elements that are purely rules-based, and those rules may not really be applicable or reasonable in certain circumstances. So we need to, as part of that engagement and collaboration with the regulators, and part of the incentives that need to come through from the regulatory standpoint is to truly create that room and flexibility for a more risk-based approach. And then also related to that is some gaps or weaknesses in terms of the feedback loops. So we have the aspect of filing of suspicious transactions. So when we file these suspicious transactions, I'm not sure how many jurisdictions have instances where the regulator comes back to then provide insights or information on what then transpired. Was the report of good quality? Did it translate into actionable intelligence to then, manage that issue and lead to also, arrests and prosecutions? It has not been very good in the past. At least I'm happy when I look at the Kenyan point of view. We've had a lot of good engagements with our financial intelligence unit, which is a financial reporting center. And we've also had engagements where they come in to give the KBA Compliance Committee updates on some of the weak areas that they have noted, where we can improve as banking institutions, what is the level of compliance in terms of the quality of reporting. And in their view, looking at the holistic picture within the financial system, are we really filing good reports, or are we just doing defensive reporting? And what does that mean for us? And one of the commitments they have made is that they will be engaging with the various banks just to make sure that they upscale the way we do reporting. Yes, Hilda?
My apologies, in the interests of time. I think we have
okay, sorry. Yes.
To see how to wind down the session.
Okay, no problem. I think then, we can really go on and on, but I'll just wrap it up and probably look at just some a few more of the practical recommendations. So one we've talked about, which is institutionalizing impact assessments that focus on financial inclusion. This would then help to better define our policies and also our risk assessments. So the national risk assessment, the sectoral risk assessments, and ultimately the institutional risk assessments. Then development of sector-specific profiles, which help us, for example, if we're looking at the NPO sector, when we're looking at, the telecom sector and how they support on mobile money. Cross-border, I think there has to be some form of regulatory harmonization. We work as a global village when we are looking at, engaging across the globe. So that means that especially through the FATF rules, there needs to be some harmonization in terms of how that works. There, ideally, to enhance the positive channels that we do have, the alternative channels, if we can move towards formalizing the partnerships, especially with those that are more established, more trusted, and can then move more onto the digital platforms, especially, that would be the easier, I think, way of doing it. For instance, the Hawala then can move more onto the digital platforms. I think that would be a win and would also enhance financial inclusion. And I guess mainly on the collaboration side, strengthen that public-private coordination, which will really help us to then, build on financial inclusion. And with that, let me stop at that. I know I'm eating into your time, but thank you. Thank you for bearing with me.
Yeah. Thank you, David. I think it's appreciated. There's a lot to talk about. I think some good takeaways that have come out from there. How financial institutions are operationalizing the Financial Action Task Force guidance, while still ensuring stringent ML-CFT requirements could lead to some populations being overlooked. And I think another key area for us is how we do need to bring on board the digital identity systems, alternative data, so as to cater for some of this population that is being unintentionally or disproportionately underserved because of the stringent regulatory requirements. And most important, I believe, is the requirement for regulators and institutions to work together so as to ensure that we are not engaging in de-risking and that we are now promoting proportionate risk management across all sectors. In summary, as we've had today, applying the Financial Action Task Force Recommendation 1, risk-based approach is not just about managing the threats, it's also about enabling access. So the future of financial inclusion clearly lies in balancing integrity with innovation and ensuring that no one is left behind in the name of conclusion. So I would like to thank all our panelists for a very insightful discussion. I would like to thank ACAMS for providing us with this opportunity today. And for all those that logged into the session, a big appreciation. I now want to hand over to Wendy from ACAMS. We have seen that there were some 3 questions on the panel. Those shall be responded to, including the request for a training or a discussion around the risk-based approach with respect to the virtual assets. Wendy, over to you, and thank you to the panelists and all the stakeholders that came into the session today. Appreciate it.
Thank you, Hilda. I can see that we have some questions. We will get back to you and we will share the questions with our speakers. And if you have any questions, you can contact us on the East Africa chapter email. That is eastafricachapter@acams.org. And thank you, speakers, for spending your time speaking for ACAMS. We hope to welcome all of our audience next time. Thank you.